That way they get the initial thing. Awesome. Well, welcome to NCraig on this beautiful last day of May. Upcoming classes. How are Tuesday classes going, James?
They're going amazing.
Amazing. I bet no one expected that.
What's that? They are
The most amazing. Especially when Rubik's Cube shows up and Nomad is Amazing shows up.
That's actually not right.
That's what's on your website.
There's one before them. There's 10 and screening next week.
All right.
So
Well,
10 and screening next
10 and screening is next week, which is not on here. And then after that, there is no class on June 20th. And then the following one is tenant buyer sales and marketing.
Yes.
And then there's no class again because it's July 4th, because James will be not setting his house on fire and lighting fireworks off instead. And then on July 11th, he's going to apparently teach the $5,000 lease demystified. All right, what are you going to teach then?
For the $5,000 lease.
Yeah, what are you going to teach?
I'm going to teach the lease. And I'm going to make some modifications to the lease before then, time permitting.
Excellent. Next, it is next Wednesday. Next Wednesday, James is teaching buying properties on lease option, lease purchase, or subject to. What do you want to tell us about that?
It's going to be amazing.
Other than it's going to be amazing.
So that's the class where we start talking about how to buy creatively. Those are the primary 3 ways to buy creatively in our market. Not that you can do that right now, but we want to make sure, since we only do these classes once a year, we want to make sure you're prepared. So if the market does start to slow down later this year and you do marketing, find deals off market, you'll be ready to do this. Plus, we'll record it for clients, they can watch that in the back. So that's really going to be the class. It's going to be basically deal analysis for lease option, lease purchase, and subject to deals.
Yep. And then the week in between here, there is no class apparently, which was news to me when I saw it get canceled because I thought we were doing like a meetup event.
Oh, I can change it.
Perfect. So we might be having beers and meetup somewhere, or we might have no class. Either way, don't show up here. And then the week after that, from all the surveys that you guys filled out, that is why that class is back on the schedule, is bookkeeping and accounting. How many people want to see that class again? Yeah, those are the like 8 people that send in surveys. And I'm like, really? You want to see that again? And if you haven't filled one.
Yeah, if you haven't filled one of these out, please raise your hand. I'll give you a copy of it. But it's really a list of the classes that are upcoming. You get to pick what you want to see on there. And then we will use this feedback. To determine what classes to schedule, because July, I think, is pretty much wide open right now.
Yeah, and last summer, it was awesome because James pretty much taught July and August because it was all of the like off-market stuff, which is great. So if you guys want to write that stuff down on the surveys that you should all fill out tonight, especially note, I would like to see James teach seller presentations. That would be amazing.
I don't even think that's an option on there because I designed it.
Right, you can write it in though. Write it in and give it 6 votes. So before we do introductions tonight, there's 2 articles that I got in the mail this last week. How many of you guys saw an article? It was probably published in the Coloradoan that was about, this firm says that in 2019, property prices in our area are going to decline by like, I don't know, 20% or something crazy like that. James saw it, Daniel saw it, Brendan saw it. So it was kind of one of those like, hey, they're trying to say, oh, you're in a bubble. And so I'll just read this really quick. The out-of-state data analysis firm recently made headlines with the prediction that front-range home prices would start falling in 2019, driving median home values down by 5.5% in the Fort Collins area by 2022. So it wasn't 20%. But while Greeley area prices are expected to stay level, see, Greeley is amazing. The firm's outlook says Denver prices will fall 11% and Boulder will fall 17%. There are ample reasons why this forecast, which appeared as front page news in the April 16th Denver Post, as well as the Coloradoan, doesn't add up. Here's 4. First, as anyone can attest to, it's hard to buy a house right now because there's limited inventory, right? That's not really a sign of a bubble. And it's not likely to change in the next year or 2, right? I don't think, hey, it's 2017, we're about halfway through the year. Are we really expecting a year from now to have ample inventory? Probably not. Things move a little slower than that in real estate. Second point, the forecast points to how local household incomes are not keeping up with prices and the lack of affordability. And as I've said in the market analysis, and as James has said in the market analysis, it doesn't take into account one thing. What is that?
Immigration.
Close. What's one major thing in Fort Collins that's amazing?
James.
Sweet! CSU, right? The kids essentially, for the most part, make $0. So, see? So you've got 30,000 people making zero and 120,000 people making everything else. It pulls the median income down and makes it look falsely like it's not affordable. However, in the affordability index, it actually takes that into account. We've shown that it actually is one of the most affordable in the US. That's point 2. And then third, affordability is not just about incomes. Mortgage rates, which are still at historic lows, and property taxes, which are also, Colorado's are among the lowest in the US, need to be accounted for when actually measuring what your purchasing power is. So that's 3. And then number 4 basically says, remember the Great Recession of 2008 to 2010? Fort Collins prices dropped how much? A little more. Like 4% in that period. See the accompanying chart, which you can't see, but you've seen it before because I've shown it and James has shown it. For the dire forecast to come true, the metro area selected as the most stable real estate market in the country will need to lose more value between 2019 and 2022 than it did during essentially one of the worst real estate markets of our lifetimes. So take it for what you will, but it seems unlikely, right? It seems like, hey, we're a firm, we're trying to get some publicity. I don't know why they're doing it. Second article, I don't know if you guys saw, Fort Collins and Loveland is the most stable housing market in the United States as of right now. So there you go. I don't know how we're going to just suddenly dive, but I don't have a crystal ball. So if you're feeling like selling your properties at a discount, see me after class. All right, introductions. Introduce yourself and what kind of real estate you do. This is an opportunity, so if you're like, hey, I have a deal or whatever, say that. Other people will talk to you after class. And the question of the night is, have you done a 1031 exchange? Because that's what tonight's class is about. If you thought you were like on a plane to San Francisco, please exit the plane now and get on the 1031 exchange bus. And if so, were there any surprises for you during that 1031 process? And as always, we're going to start with James to avoid him having any anxiety because he's thinking about his house being on fire.
That's true. I'm James Orr. I do mostly residential real estate. I've not done a 1031 exchange, but clients have done 1031 exchanges. Not really any surprises.
Well, if you haven't done them.
No surprises for clients.
Perfect. Lashana.
I'm Lashana. I like to do fix and flips. I'm doing Nomad this year and maybe getting a rental next year as well. 1031 exchange, I have not done one myself, so there are so many surprises coming.
Just want to make sure.
I know. Thinking the same thing.
I'm Anna Silva. We have a few rentals here in Fort Collins. I have not done a 1031 exchange yet.
Perfect.
I'm Dan Silva, and same story. And we looked into doing a 1031 exchange, but the more we researched, the less it was attractive. Like the tax part of having to pay your depreciation back into it, and the whole thing became less attractive by the minute. So
Huh. We will try and address that.
the tax part was.
Perfect. Daniel.
My name's Daniel. We've got a couple of rentals and we're looking at nomading possibly this year. I'm starting to get my wife to be happier about me.
Who, oddly, you didn't bring tonight.
She's planning and stuff. This year I want to do that. Our first nomad style. Well, it's not really our first. We inadvertently did one without calling it that. And I want to get serious about finding a CPA and tax and real estate attorney this year as well.
Perfect. So somebody else asked me before class, so Brennan and Daryl sitting behind you, you might have some questions coming at the end of class for CPA referrals. Oh, he just changed colors. Dun, dun, dun. Nice. Now you're green. Eric.
My name's Eric. I don't have any rentals yet. I'm hoping to get some in the near future. I've also talked to my wife about doing Nomad.
We should trade notes after class.
Right. It's a work in progress. But I don't know anything about 1031 exchanges right now.
Perfect. Hopefully you will after class, or I will have failed my duties in teaching. So, Joe.
I'm Joe. Currently have single-family rentals right now. Looking to do multifamily, and I know nothing about 1031 exchange.
Great. We have ample opportunity to teach tonight. That's awesome. Allison.
Hello, I'm Allison. I am being eased into thinking control of a rental property, and I have never done a 1031.
Perfect. That would be amazing if you had. I started investing when I was 8. Did a 1031 first when I was 13. Yeah. Lee?
I've never done a 1031, but I'm very interested. And
Perfect.
I'm looking for a buy and hold.
Awesome. Cool. Are you doing Nomad too? You willing to move?
I've considered it seriously. It's what I wanted to do when I was younger, and everyone told me that, and I wish I had.
Yeah.
Good idea.
Yeah. Does she get half a green name tag at least? You know? Brendan.
I'm Brendan Foster. Like I say, own a handful of buy and hold long-term stuff in northern Colorado. I've never done a 1031 exchange, but may have the opportunity to do so in the next few months.
Nice. Daryl.
Daryl Stolte. My wife and I have got several buy and holds, some multis, doing a couple lease options, and I also lend money. I coincidentally will have a pretty good chunk of money available in a week. So if you need some money, come see me.
I need some money. Does anyone need? Everyone should talk to Daryl after class. It's just like, do you need money? Talk to me. Yeah. Jesus?
I'm Jesus. I hope to have my first rental in a couple months. Sort of like an unplanned nomad.
Green him up. Green him up. Unplanned nomad. That's weird.
And I've never done a 1031, but I'm really interested.
Cool. Karen?
Karen, and we have a couple of rentals in the area. We tried to do a 1031. Our plan was to do a 1031 with our flip that we did last year, and that didn't happen. So that was a big surprise that you can't do a 1031 flip. So
Yeah.
that
That's literally a bullet in my slides.
So anyway, so I came to learn some more since that was a huge shocker for us.
Yeah. Yep. Angie.
Angie, we do Nomad, and
We already have a green.
That's right. Just making sure.
They're greened up.
we're getting ready to do a second Nomad, and we have a self-directed IRA, and not done a 1031 exchange.
Nice. Mark, have you done anything different?
I have not,
That's interesting.
but I was able to convince my wife to do nomad.
We're gonna start a spouses that need
So,
Exit plan.
Eric and Daniel meet Mark.
Maybe your wives need to meet me.
Oh, there you Yeah, and that's why it worked right there. Did you see that? He's like, it wasn't me, it was all her. Yeah, nice. Alan.
Alan, I'm doing Nomad, the green sticker. And I don't know too much about 1031, so I'm sure there'll be a lot of surprises.
Perfect. Scott.
Yeah, I'm Scott, Fort Collins guy. We've been into rentals for about 10 or 12 years, I guess. We have a single family here in town still, and want to add some more. Never done a 1031 exchange. Would be interested in Nomad if I could convince my wife. So, yeah, that's why we're here.
Perfect. Haley.
My wife, this is my daughter, by the way.
Your daughter should also do Nomad.
You're getting greened up.
I'm Haley, and I'm brand new at this, so I just graduated from Front Range, and I'm hoping to do Nomad for my living situation.
Nice.
What was your name again?
Haley.
Haley?
Yeah.
And I have not done a 1031 exchange.
Awesome. Well, you're in the right place. That's awesome. Congratulations on graduation. Yeah. Zach?
I'm Zach. I own a couple rental units in Loveland. I've got my first kind of fix and flip under contract, which I'm pretty happy about. And I guess we're kind of doing nomad. The house I was living in, ended up fixing it and selling it, and then bought another house here in Fort Collins with the intent of pretty much doing something very similar. So it'll be very similar to a nomad situation.
Nice. Soon there will just be a sign on the door that says, if your name tag is black, you're in the wrong place. Nice. Kim?
My name is Kim, and I have a couple rentals here in Fort Collins, and I'm closing on some properties in Tennessee. I'm working on cash flows, buy and hold there. I'm supposed to close this week, my fourth one. I have a house in Boulder that my twins live in, and I would love to sell it out from under them and buy a couple properties that would and fight all the time. So if I could figure out how to do a 1031, I could rip that Boulder property out and get some couple of more.
Then you're in the right place tonight. That is for sure. I don't have the the bad situation in there, like how to make your descendants not happy or something like that. But,
Isn't it a job description for parents?
Oh. It was for me today, that's for sure. Yeah. Excellent. Hello.
Hello. I'm Karen. I'm just basically supporting him and whatever he wants to do. And I don't know anything about 1031 exchange at all.
I'm Curtis. I'm a beginning investor. I can barely spell 1031.
DEN31. Just like that. Yeah, nice. Hello?
Jets. And my wife and I, we have several rentals in Colorado when we moved in 2 years ago. And we never done any 1031 exchange before, but we do have a rental back in Atlanta, Georgia, so we may consider it.
Awesome. Thank you. Nick.
I'm Nick. I do buy and hold, and I have not done a 1031 exchange.
Nice. So no surprises. And I don't know if you all are aware, but we actually have royalty in our presence tonight. The mayor of Wellington is back here. His name is Mitch.
There he is. I'm Mitch Reynolds, mayor of Wellington.
Where's the t-shirt? We have to get it now. It's going to be awesome.
I do all kinds of things in real estate. I have a rental property here in Fort Collins, 2 years of commercial real estate appraisal experience. I just landed a new job in Fort Collins, actually.
Do what?
Commercial real estate appraisal.
Nice.
So I'll also starting a property management company here at the end of the year. I'm a licensed broker, but I don't really pursue sales business. And I might do a 1031 eventually. I'm kind of interested in selling that residential rental and maybe partnering with this new appraisal firm for some office space. So I'm playing around with that idea. Are you guys CPAs? Is that?
CPA.
No.
No. We have referrals. Okay, gotcha. So I was just curious about that. So I am looking into 1031, so it's really relevant to me. So I'm glad to be here.
Nice. You won't have time to be the mayor once you start that property management company, though. You're going to be just busy. Beth.
I'm with Zach, so he has the rentals and he's kind of not dragging and going willingly along with us. We have talked about 1031 exchanges and keep hearing like random things like you had to like buy it as an investment property to be able to use it and things like that. So we're interested in learning what you know.
Cool. Well, hopefully I know a little enough to teach. Daniel.
I'm Daniel. I'm doing the nomad. We're in our second home. A few homes in Wellington. I'm interested in doing a 1031.
Sweet. Did I miss it? Has anyone in here done a 1031? So it's just me. So I can tell you anything and you'll believe me. It's going to be an amazing class. Important note number one, please don't take photos or slides or videos or record audio because apparently we cannot even record audio and video of our own presentations, so you shouldn't try because it won't work. And number two, Just silence your phones and laptops for me. Tonight is 1031 Exchanges. If you don't know me, I'm Brian Williams. I own rentals in Fort Collins, Loveland, Windsor, Evans, Greeley, Longmont. Oh, did I not say that? Yeah. Fort Collins, NoCo, northern Colorado, from single-family homes to small apartment buildings. And I actually have done some 1031 exchanges, and there's probably only one surprise, which is in the slides, so I'll leave it for that. Here's your disclaimer for the night. It's not as long as the asset protection one, but I am not either of these things. If you need a CPA or an attorney, apparently you should talk to Brendan or Daryl. They've got good referrals. This is not legal or tax advice. Please consult your professional. Having said that, what the heck is a 1031 exchange? And there's a lot of text on some of these slides. I tried to break some of them up, but I'm like, man, that seems small already. So essentially, when a business or an investment property is sold and there's a gain, normally you'd have to pay taxes on it. A 1031 exchange allows you to essentially not have to pay that tax. And the reason it's called a 1031 is because the IRC, which is the Internal Revenue Code, Section 1031, essentially defines what this plan is. So you can postpone paying the tax if, right, big if, right? You can't just be like, I'm going to do 1031 exchange and never pay tax. I sold a property. Doesn't work like that, right? If you reinvest the proceeds in a similar like-kind exchange, right? What's like-kind? Can I sell a single-family home and buy a 100-unit apartment complex? Yes. That actually is like-kind. We'll get to like-kind in a minute, right? The key point here is that it's deferring your taxes, right? It's not like indefinitely postponing them or eliminating them. It's just deferring them. And because James wanted in there, the second to the last slide shows you how you can essentially eliminate them, when you die. So we'll talk about that. What's awesome is it really, for the most part, doesn't matter who the owner, and in this kind of class, taxpayer, right? Because that's really where this matters, right? Who is the taxpayer? It doesn't matter if you're an individual, a C Corp, an S Corp, an LLC, some other entity, as long as it's a tax-paying entity, right? If you're not paying taxes, you're already going to prison, so look out. This has to be distinguished from simply hey, I sold this property and I bought this property. I'm going to call this a 1031 exchange and defer taxes, right? That doesn't constitute a 1031. That's actually a taxable transaction. You call James, say, I want to sell this property, and then you take the proceeds from that one and you buy a different property. That's taxable, right? You haven't done a 1031. In order to qualify, the sale and the purchase have to be mutually dependent parts of an actual exchange, typically using a qualified intermediary. Is your referral for your qualified intermediary the same one I used?
That was First Bank.
Yeah.
I think I have First Bank in there, and I think I also have a couple title companies in there.
Yeah, so I will just say that I used First Bank 1031 Corp, which is a separate company from First Bank, and they were fantastic. So if you're looking, and they've got a great website, if you want more information after class, go look them up.
I don't know if you have a slide on this, but 1031.
I am only on the first slide.
I know, but this is the appropriate point for this bullet point about who they are. So the 1031 exchange companies is a largely unregulated industry.
I have a slide for this. Yes. So most 1031 transactions are done through an exchange facilitator. Like I said, I believe it's efirstbank1031.com is their website. If you just do firstbank1031.com, it's actually a totally different company. So in 1991, the IRS issued what's called safe harbor. How many of you have talked to your CPA for other reasons about safe harbor stuff? At least a couple people. Typically, when you're dealing with expenses on a property and what you can expense versus depreciate, safe harbor tends to come up. So in 1991, they established approved procedures for doing 1031 exchanges. Prior to that, it was like, hey, IRS, I sold this property and I bought this property, and I'm calling it a 1031 exchange. It really wasn't a 1031, but I'm calling it an exchange where I should be able to defer taxes, and it had to stand, every single transaction had to be able to stand on its own merits. So you were going to basically put yourself at risk of having to defend it against the IRS, which in the 80s and 90s, I mean, they were a lot more powerful than they are now. Practically, When you do a 1031 exchange, you're signing basically two documents. One is the assignment of your contract, right? Because it's not really you. You're signing an assignment of contract that assigns that contract to the intermediary. So in this case, First Bank's 1031 Corp, and an exchange agreement. And the exchange agreement, the assignment's like a one-page, like, hey, I'm assigning my contract, I signed it, and they sign it, and you're done. The exchange agreement is like a 7 to 10 page agreement that basically defines the terms of the exchange and all the rules that we're going to cover tonight. Any questions on that? Excellent.
Are you going over that it has to be in the contract itself? The additional provisions?
Yep. It actually doesn't, but yes, I will cover it. Types of exchanges. So there's a lot of different types of exchanges, and one that I was not even aware of, so I put it in here so we're all going to learn together, which will be awesome. The simultaneous exchange, which for all practical purposes, no one in this room will probably ever do, because it's essentially, hey, James, I'm looking to trade my property, and you have the property that I exactly want. Oh, and guess what else? I also have the property that you exactly want at this exact moment. Would you like to swap deeds? So that could actually be, we just literally swap deeds. That could be a 1031 simultaneous exchange. Simplest exchange to do. Don't need a qualified intermediary, but it's also hard to find James at that exact moment who wants exactly what I have and I want exactly what he has in that exact moment in time. So in practical world, this is probably not going to happen. This is the one we're going to focus the most on tonight because it's the most applicable to real estate investors in my opinion. There's two other ones that will play a role, but this is the primary point of class because this is probably 95 to 99% of all real estate investor 1031 transactions that are done, which is called a delayed exchange. It's much more flexible. Basically, you can sell one property and then you can buy one or more like-kind properties at a slightly later date. I just said that. Next type of exchange, I'm going to come back to the delayed exchange and cover it in depth for the rest of class. I'm going to get the other two out of the way. Reverse exchange. How many of you guys know what a reverse exchange is? James, what's a reverse exchange?
You buy the property you're going to buy first, and then you sell the old one.
Yes. So this is fairly crazy when you think about it, right? You're like, I found the perfect property that I want to 1031 into. I would love to buy this 12-unit apartment building by selling my fourplex. But this just came on the market. I need to buy it now, right? In our market, I need to go buy it. So I say, okay, I'm going to go buy that. I buy it, and then I sell my old property, and I'm able to use the proceeds from that old property to then technically purchase the new property, even though I've already purchased it. That's kind of awesome, especially in our market, right? If you're like, I'm not really thinking about selling, and tomorrow a 20-unit apartment complex comes on, and you're like, I would love to sell my eightplex and own that. It's in a better location. It's better rent. You can do that. It is more complicated. It does cost more, which will cover costs at the end. But basically exactly as James said, right? You acquire replacement property, and then you sell the relinquished property. There are a couple rules that go with this. There's a 5-day rule, which is, I'm going to read it because this is kind of interesting. You must enter into a qualified exchange accommodation agreement after title is taken by the exchange accommodation title holder, which in most cases is going to be your qualified intermediary. So like 1031 First Bank Corp, right? They're essentially taking title to that property, right? However, within 45 days, you have to identify the property that you're going to sell that you would then use the proceeds to buy that property with. And within 180 days, that whole thing needs to be wrapped up. Or does it? It actually doesn't. So you can take longer than 180 days in this type of 1031 exchange. However, we go back to outside of safe harbor, and it has to stand on its own merits. Which, in a lot of cases, what's happening is this is like a build-to-suit situation where it's going to take longer than 180 days for them to actually build the property that you want to transfer into through your 1031 exchange. Does that make sense?
I thought that was the sale. I thought that can take longer than 180 days would be the sale of the previous property, so it's not a build-to-suit situation. Takes longer than 180 days to sell it.
It takes longer than 180 days to complete the transaction. So they're holding title to the property. You may have relinquished your property, but this one's not ready. Right? That's the typical case for the longer than 180 days.
Okay, I'll think about that one.
All right. Let me know if you have questions, and I'll direct you to 1031 Corp at First Bank. Yeah. So here's the one I was vaguely aware of, but knew basically nothing about before I did some research, which is an improvement exchange. Title holding exchange is another way that they actually use it as terminology. This is essentially where you go and acquire a property and then improve the property prior to you taking title. Why would you want to do that?
Get a higher basis.
Yes. You would want to have that property have a higher basis so that you can avoid any what is called boot, which we will cover in a second, which I just realized that I put on this slide without telling you what it is, so hold that thought. But really, this is typically done on an unimproved lot. You're buying a lot and you're like, hey, I'm going to construct a fourplex on this lot. I'm going to have the intermediary hold title. I'm going to build this fourplex, and then I'm going to transfer into it. So that's pretty amazing. This is also used, so if you bought a property and it wasn't quite worth enough for you to transfer without paying additional taxes, you could then improve that property to make its value go up so that indeed you would not have to pay taxes. And I'll explain what boot is in a minute. So essentially what happens is your intermediary, 1031 First Bank Corp., closes on and takes title to, right, this property, which is different. And they hold that title until the improvements are completed, and then they convey the title to you as the taxpayer or your entity or whoever is doing the exchange. Does that make sense? You got a lot of options. What qualifies as like kind for an exchange, right? Can I sell my car and like kind exchange into a single family house? Maybe it depends if I was living in my car. I don't know. Just kidding. It's still a depreciating asset.
Is it a tiny house?
Oh, man. Our tiny house is actually, I don't even know this. Our tiny house is,
They're not deeded.
yeah. Like, is it a car, essentially? Is it like an RV?
I don't know.
Is it a depreciating asset?
Time will tell.
I think if it has an axle, it's personal property. If it's like on a foundation, it'd be real property.
Little did everyone know that's buying tiny houses that they're just buying cars, right? I mean, terrible. So what's like kind? Both properties, and this is super key, right? Both properties must be held for use in a trade or a business, or it needs to be an investment property, right? Or sorry, just an investment, because it doesn't have to be real estate. We're only covering real estate tonight in case you have any questions. Primary residence, second homes, vacation homes in the mountains, can't do it. Although there's a small exception to how you might be able to do that, which we'll cover at the end. Thanks to an email that James sent like 2 years ago, which I knew he'd be like, I bet you're going to have a slide on that. Properties must be similar to one another. So what does similar mean? Like 3 bedrooms to 3 bedrooms?
Same color.
Same color? Same number of garages? Same city? Like, what do you guys think it means? So rental, any rental to any rental. Fair enough. What might not count? You're downgrading. You can still do a 1031 downgrade. You're just going to run into the boot issue, which we'll get to. So same nature, character, class, but the quality or the grade of those properties, right, doesn't matter. You can take $1 million rental and buy the crappiest 8-plex you want, right? The quality of that property doesn't matter. Most real estate, thankfully, is like kind to one another. So there's not too many things you're going to miss. A residential house is actually like kind to vacant land, which doesn't seem like kind, but again, it's a real estate investment. There is an exception, US property and foreign property, not like kind, right? And I'm not sure why they did this, probably so that you couldn't move your money outside the US without paying taxes, but it seems logical.
Do you think they would do that? Do you think the United States would? Prevent you from moving from.
I don't think so. I mean, there's like all these bank accounts you can have. Improvements conveyed without land are not like kind to land. So a townhouse usually is conveyed with land, right? Oh, tiny house, yes. So a tiny house may actually not be, if you buy 20 tiny houses and rent them out, may actually not be like kind when you want to sell them all because they don't have land. Now, if you plop it down on an acre of land somewhere and deed it with that, I don't know. Call a professional. I am.
What about condos?
Right, and that's the real one that comes up with this for me, right? Is a condo is not conveyed with land.
Right.
It's like you own the space in the air right here where we built some stuff.
Yeah.
But the HOA owns the land typically. So I'm not sure how that would work. So if you're going to 1031 a condo, call your 1031 professional.
And I think that's the answer to all these questions, right?
Yes.
Double check.
Yes, don't depend on what I'm telling you. While 99, hopefully 100% of it is correct, call your 1031 professional. Real property and personal property can both qualify. Again, if you're doing personal property stuff, call your 1031. We're definitely not covering it. But these two are never like kind to one another, right? Personal property, like, hey, I own this refrigerator, right? I can't like kind exchange that for real estate.
Are they segmenting that out? Are they saying, you know, blinds and refrigerator and washer and dryer is not?
Yeah, I did not cover this because it is so incredibly complex, and even in my 1031 exchanges, it did not come up. So
They just assumed it was all real property, sort of? They closed their eyes and pretended?
I guess, right? Very much like when you sign the TD 1000 at closing, right? How many of you know what the TD 1000 is?
That's like a Terminator, right?
Yeah, she crushes the skull at the beginning of the movie. No. So like when you last bought a rental property, you fill out a form and the closer probably hands it to you and tells you you probably want to mark average. Do you guys remember that form? That form actually on it says, is there any personal property that is coming with this property? And no one ever writes down, well, yeah, I'm getting a refrigerator and a dishwasher. Of course you don't write it down. So no one writes it down.
I will comment that that is a Northern Colorado custom.
Yes.
And in other parts of the state and other parts of the country, they do.
Yeah. So again, consult your attorney as to what you should actually do. I am not one and cannot give legal advice. But in a 1031 exchange, you are only exchanging property for property, or property and land for property and land. So that refrigerator that's in the house or anything that's personal property is really not supposed to be a part of that exchange. Again, this didn't come up when I did my exchanges, so I'm thinking it's much like custom in Northern Colorado for we just kind of wash that under the table and close our eyes. But you might want to call your attorney. So there are some exclusions from 1031 exchanges. Inventory or stock in trade. So if you're running a business and you've got a lot of inventory, you can't like kind exchange that for other inventory. Stocks, bonds, or notes, which should be fairly obvious. You can't go buy 100 shares of Microsoft and then say, woohoo, I want 100 shares of Dell. I'm going to take my extra $10,000 I made on Microsoft stock and I'm going to 1031 it into Dell stock, right? Doesn't really work that way. Otherwise, we wouldn't need financial planners because they wouldn't be able to be like, oh, if you sell this, you'll take the loss and then you can invest it in this and get the gain, right? They do more than that. I'm just kidding. Are there any financial planners in the room? Perfect.
Lose their hand right now.
Other securities or debt, partnership interests. So this one you should stop and think about, right? So if you are a partner in an LLC and you want to 1031 what your, let's say James and I have a partnership, I've got 50%, he's got 50%, and James says, I'm done with this, I'm going to 1031 out of this, and I'm like, that's fine, I'm just going to take the cash. He can't actually do that. However, we'll explain how you can get it done at the end of the slide. Yep, and some other stuff. Certificates of trust, and then Karen's favorite bullet point, fix and flips don't actually qualify, and it's really the intent that matters. And that is a lot of tax code with the IRS in a lot of places. What your intent is actually matters more than what happens in many cases. As an example that's separate from 1031, James and I bought a property together, and the intent was for it to be a long-term rental. It turned out to be a less than 60-day flip. However, my CPA, because I bought this tax course and I went through it, and it was probably worth the $2,000 just for this nugget, right? Which was, I was able to write a letter that said the intent of this property was for it to be a long-term rental. It didn't turn out that way, but it was still taxed as a long-term rental, which is pretty awesome. So
how far in do they go with intent is the question.
what do you mean?
Like, is it intent when we put the marketing out to find the property? Was it intent when we put it under contract? Was it intent when we close? Is it?
I mean, there is no definition, right? And so if I think had James and I done this once, and they look and they go, oh, Brian owns X number of other rental properties. This is the only time he's ever done this. I think it's an easy pass. Yeah. Now, you do it a second time in the year, and they go, huh, nice intent. He's doing 45-day flips and making 50K, and we're taxing it differently. And then you start pulling that every year, and suddenly you're running a flip business, and it's really your intent's you're gonna come back and get hammered. Yeah, Mitch.
How about selling a property to, say you have a portfolio, or say you have two, selling one property to pay off debt on the other one?
Nope. So you're gonna end up paying boot on that essentially, right? Because you're not, let me get to the boot slide and that'll make a ton of sense. So.
Sorry, I'm gonna jump in. So the intent, so if we have a property that our intent was that this property was gonna be a rental, but then we decide to sell it before that year is up, then we can get our CPA to write that our intent was for it to be a buy and hold, and we can 1031 off of that.
So I don't know what your year is up in that meant. You said before our year is up. Why are you calling out a year?
Because the fix and flip is usually it's a year, right? You have to have, that's what.
Talking about short-term versus long-term cap gains.
Oh, you're talking about cap gains?
Yeah.
Capital.
No, I just remember that Stephanie was telling us that.
Short-term versus long-term is 1 year.
Yeah.
Yeah.
She just said that, well, you can't 1031 that flip because it's a flip. It wasn't a buy and hold.
Right. Much like, think about it this way. If your intent is, I'm going to make active income from doing a flip, that's very different than I'm going to make passive income from having a rental. If you bought the house thinking, I'm going to find a tenant, and you advertised for a tenant, and you thought, hey, we're going to rent this, and then something changed, and your intent always was this is going to be a rental, I think you have an argument for being able to do a 1031. However, you're going to need to really, it becomes a very sticky situation because the IRS can always come back and say, hey, Karen, I see you did, this flip and it took you 45 days and you're trying to claim a 1031 on it. They're going to be able to challenge that and you're going to have to be able to improve, hey, this was my intent. Stuff changed. It was life circumstances, a one-time thing, and then I think they'd let it go.
I'll make another comment. The type of financing you would use to do a flip is
Yes.
typically different than the type of financing you'd use to do a long-term buy and hold. And if you have the flip financing in place, I think it's going to be hard to.
Right. Having said that, the financing we used on our deal was actually short-term financing because the long-term financing was a boneheaded lender who wanted me to sign stuff I wasn't going to sign. And so I was just finally like, well, whatever. We just bought it. So it's really intent, but really proving your intent becomes difficult, right? If you bought it saying, yeah, we're buying it as a rental, and you wrote that down and signed it and had it notarized on that day, but the next day you were like, yeah, we're going to fix it and flip it, I don't know if that counts. So call an attorney who is very well versed in this and talk to the 1031 Corp. Any questions? Yeah.
Is a condo to a condo a like claim? You can do condo to condo?
Yeah, so the weird thing about condos, which I should have called 1031, right, is this is improvements conveyed without land are not like kind of land, but if you were doing condo to condo, according to that, I would think that would be like kind. So I would guess yes, but I didn't ask the condo question.
And the harder version of that question is something that has land, single-family home or town.
Yeah, could I do a condo to a single family home with land or vice versa, right? And that's a good question. Everyone should call 1031 Corp tomorrow and ask that same question. It'll be awesome. Any other questions? Perfect. So potential issues, right? And these are like things that people do and then they like, oh, I probably shouldn't have done that, right? If you do a cash out refinance like a month before you do a 1031 exchange, the government's probably not going to look favorably on that, right? The point is to defer the taxes with the proceeds that you already had. So you're kind of cheating the system. So if you're going to do that, either wait at least 6 to 12 months after you do the cash out refi before you do a 1031, or better yet, wait until you do the 1031 and then pull cash out with a cash out refi. Does that make sense? Super easy. Don't get challenged. Never take control of your proceeds. Oh, I sold this property and the title company hands you a check. Oh, bummer. It's just like your 401k, right? If you cash the proceeds into your own personal account, your 401k is no more, right? You just made all that gain taxable. So this is the same thing, right? You taking control of those proceeds at any point disqualifies your exchange. That's the big no-no. And what's worse, right, is not only is it no-no, but everything immediately becomes taxable gain. It's not like, oh, you can undo it. It's now you have taxable gain. So use the qualified intermediary, and you cannot act as your own. So don't think you're going to go like become your own 1031 corp and act as your facilitator to save money, because that's crazy. Nor can James, as your real estate agent, or your broker, or your investment banker or broker, or your accountant, attorney, employee, or anyone else who has worked for you in those capacities in the past 2 years. So that's just the entire like legal description. So don't use those people as your qualified intermediary. Go use somebody that is actually good. And I am not covering this in any length of detail. If you are trying to do a 1031 exchange with a related party, someone you know well, please go consult people that know way more about this than I do, because there are some crazy rules on this. It's not necessarily prohibited, but it's also, you need to be really careful as to what you're doing. Questions on potential issues? Awesome. All right, so we're back to just focusing on the delayed exchange, right? Which is, I'm going to sell this and I'm going to buy something better, right? So that's what we're focused on for the rest of the time. There are a couple rules that go with this. The 45-day rule. Anyone know what the 45-day rule is other than James? Anyone want to take a guess?
You have to be under contract within 45 days?
Close. Kim?
You have to identify a property that you want.
Yes. This is the identification time period. And when does that clock start? When you sell your place. Correct. On the closing date. So you must identify potential replacement properties within 45 days from the date the relinquished property is sold. So this creates some interesting stuff. I decide, hey, James, can you help me sell this property? I really want to get rid of it. I'd like to buy something better. I got a lot of equity. And I say, go ahead and list it today, right? My 45-day clock hasn't started. But 20 minutes later, I have 6 offers, right, for over asking price. And one of them wants to close in 5 days, all cash, right? My clock is going to start really, really fast. So as you think about 1031 exchanges, and we're going to talk a little bit more about this later, think about the time clock, because 45 days, like, that's like 6 weeks plus. It goes so incredibly fast, it's not funny. You must have your identified properties signed and delivered to your intermediary, or it doesn't count. I can't sign it, I can't tell James, I can't tell my attorney, I can't tell my CPA. It's got to be in writing, it's got to be signed, and it's got to be an identifiable property. Clearly described either with legal description, street address, or some other name that is distinguishable. Why are you laughing?
Brian,
Yeah.
what happens if you identify a property and then something doesn't go good with that? Can you identify a property?
Yes. So
Your time period?
it does not extend the time period, but the next slide is the different ways you can identify multiple properties. So hold on to that for 1 minute. It's hard to get it all out at the same time. I try to put it in the best order I can to make it make sense. There's a 180-day rule. This one should be easy. What has to happen in 180 days? Everything needs to be wrapped up. And unlike the reverse exchange, although this may not be entirely true, unlike the reverse exchange, if you don't finish in 180 days, I actually believe your 1031 exchange is terminated. There is no going beyond like the reverse exchange where you're outside safe harbor. In this case, it's just you missed your window for the exchange, now your gain is taxable. So exactly what you guys just said. The replacement property, the one we're buying, which I guess is over here. This is the one we're selling, it's over here. We're buying this one. It must be closed on within 180 days after we sold this one, right? Which even that, 180 days can go very quickly depending on the size of property you're buying. Kim, do you have another question? Okay. I can see in your eye, you were like, I have a question, but I'm not sure how I want to ask yet. Zach.
Does the property you identified to purchase have to be for sale, or does the owner have the intent to sell it? Do you have to identify that in your listing?
They don't care. You're identifying the property, and it's your responsibility to make sure that you're able to purchase it. Yeah. The replacement property must be one or more of the properties identified here. You can't identify properties, which we'll discuss those rules in a second, and then decide, oh, this better deal came on the market, I'm going to buy that one instead. Nope, no dice. You're done at that point. By the way, unlike normal transactions, where in the contract for Colorado it says, hey, if the date falls on a federal holiday or a weekend, it goes to the next business day. Nuh-uh, not in this case. This is 45 days. So if your 45th day is on Thanksgiving, you better get it done before Thanksgiving because it doesn't care. Any questions on that?
Do you have a slide on how this affects motivation for buyers and sellers when they're in the middle of 1031?
I did not. But if you bring that up when we talk about what to put in the contract, we can talk about that again. Don't let me forget. Replacement property conditions. So here are the rules. This is the question Kim was asking. How can I identify properties, right? And there's 3 rules, which sounds like great news, but it's not really great news. It's more like one of them's amazing, the second one's kind of okay, and the third one is like, yeah, that's dumb. Like no one's ever using that one. The first one, and the one that most real estate investors will use, is you can identify up to 3 properties that have any value you want, and you can buy 1, 2, or 3 of them. So pretty easy, right? You're going to sell a single family home. Your intent is to buy one of these 3 duplexes. You work on it, and you decide this is the one I'm buying. You're good. You decide, oh, I have enough money. I'm going to buy 2 of these duplexes. That's great. I'm going to buy all 3. That's fine too. If you buy none of them, what happens? You don't have a 1031 exchange that's valid, and you get taxed on your gain from the sale. So this one's super useful because a lot of people are moving up from single-family home to duplex, or single-family home to fourplex, or fourplex to eightplex, or fourplex to 12plex, or something like that. Second rule, covered that. Second rule is the 200% rule. So whatever we're selling over here, we can identify as many properties as we want, right? If you're only going to identify 3, you're basically using this rule. But if you're identifying more than 3, we can pick as many as we want. We're selling a house in Boulder that's worth $1 million, and we're going to buy 10 houses in Tennessee that are each worth 1/10 of that, right? We can identify 10 of those, and then we can buy any number of those, which is a nice rule to have, especially if you're moving from a market like Boulder to like Nashville, right? Does that make sense? It's an okay rule. So you could pick 6 properties, and you could buy 1, 2, 3, 4, 5, or 6 of them. We'll discuss the boot issue. The last rule is the 95% rule, which is pretty much unusable for real estate investors in almost every case because it basically says, hey, you're selling this stuff, identify as much stuff as you want, but make sure you buy at least 95% of it. That's really tough, right? You identify 20 properties, assuming they're all the same market value. You have to buy 19 of them. It's not very useful in the real world for us. Any questions on that? These are super important because this is how you identify, and this is that first step. This is the, I'm going to sell my property. Boy, I better have something identified. How do I identify, right? Yeah.
Question. So in a market like today,
Yes.
things go on market and sell in a couple of days, right? So identifying means you probably already have an offer, you guys already have a contract on
Yes. So I hope it's my next slide. Oh, it's not my next slide. I should skip ahead. I will reorder my slides for next time to put that right after. But yes, hang on to that for 1 second. We'll talk about in this market. So here's an example to put it in perspective for you. It's 2013. We go out and we buy a house for $250,000 in Fort Collins. Don't we wish it was 2013 again? Yes. The answer to that question is yes. We put $50K down, and in 2017, what's that property worth? Probably like $350 or $370. But in this case, we're going to assume it's $325. So if we figure out, hey, we put $50K down, we've got $75K of appreciation, right? We've got $125K. I'm like waving my hands and squinting really hard that closing costs and loan pay down are all equal, right? So just bear with that. There's other minor costs, but these are the two major ones, right? You have $125K to deal with. Without it, what are we doing? We're paying gains on that $75K of profit. What's the tax bracket for that payment on that $75K? It's long-term cap gains, right? 15. In some cases, 20, depending on your income. So you're going to pay 15% of that $75K in that current tax year, plus you're going to recapture all the depreciation you took at a rate of 25%. So it's a pretty big tax bill, right? If we could avoid that, we might want to, right? Yeah.
So the depreciation recapture is going to be taxed at the ordinary rate, right?
Sorry, say that again.
So the recapture of depreciation would be taxed at your ordinary rate, right?
Recapture's taxed at 25% all the time. I'm killing my noisy whatever's going on out there.
Oh, is that what it's outside?
Yeah. Yeah, so recapture is taxed at 25%. When did we do that? Was that the world's most amazing class where we did 15-minute things?
Yeah.
So if you have access to James's presentations, I covered a 15-minute short segment on depreciation that's super interesting because we pay depreciation at different rates. Now we get credited for it at different rates than we actually have to pay the payback. So what tax bracket you're in actually matters a lot. But when you're paying depreciation tax, recapture is 25%. So you've got a decent tax bill here, right? I mean, it's at least, what's 15% of that? Like 10,500? 15% of 75? That's not right. 7,500.
Like 10,000 and change.
Yeah, so like you're at least at 10K, 11K for just capital gains.
Then depreciation's about 30 grand.
Not over 4 years.
Yeah.
27, 30. Be like,
3% a year.
it'd be like
3% a year, and that's 250,000, 7,500 per year. That's 4 years. That's $30,000.
yeah, and then
Then times 25%.
yeah, so another 7,500. So you're looking at 17, 18K in tax, right? I would like to avoid that. If you could pay $500 or $1,000, how many of you would like to avoid paying 18K now? Yeah, everyone's hand should have been really high right there. So with a 1031 exchange, why we're all here, right? What do? We buy another property, and this is key, worth at least $325,000, right? And we put all that money down on the property. That's awesome. How well is that thing going to cash flow? Much better than it will if you put 1% down. So, or you can buy a fourplex worth $500K and put 25% down. And this is what people typically have done in the past, right? They take a single family home, they let the appreciation go up, and they step up, right? They move up into a bigger apartment or a bigger piece of real estate. And then what happens, 10 years from now? You take this and you sell it and you move into a 12-unit apartment building, right? And if you did that from single family home and you had 10 of them from Nomad, and every 10 years you stepped up from 1 unit to 4 units on all of those and then 4 to 10, right? You'd have a lot of units in 20 years. Taxes are deferred until you sell this fourplex, right? Or don't sell it. What would we do instead? Thank you, 1031. Or, hey, buy a $1 million property and bring some extra money to closing, right? You can 1031 into a bigger property. You can still bring more money to closing with you from outside the 1031.
So it's interesting. I'm thinking about this, right? So the taxes you're going to pay are about $18,000. So you, instead of putting $125,000 down, you'd be putting $107 down. But not having to finance that extra 18 grand is almost $100 extra a month in cash flow. And if you think about it as terms of how much larger of a fourplex you could buy, you're really times that 18,000 times 4. So really, it's squint really hard, almost an $80,000 less expensive fourplex that you could afford to buy by not having to pay that tax.
And then you take into account the fact that that $500,000, 3% of 500 is more than 3% of 420,
Right.
and you start compounding all this stuff, and it's the butterfly effect.
Yeah, it's pretty interesting though. It's like the taxes on that example are like $100 in cash flow or $80,000 more expensive property. Two different ways of looking at it.
Yes.
It's probably closer to $75,000 than $90.
Yeah, and keeping in mind, I kept this to a reasonable I mean, it's not really reasonable, but it's reasonable given our current market, right? But in the case where, you know, a lot of you have seen a case study where I bought an 8-plex for, you know, $370, and it had, you know, in, I don't know how many years, 3, 4, whatever it was, right? There was significantly more equity because I had done a lot of work to it. Now you've got, instead of 75K, you've got 300K of equity or something like that. Play with that and start doing the math, and it becomes compounded even more.
So what would that look like if it didn't the property didn't appreciate at all? If your gain is your down payment, essentially?
Your gain, so you're saying I bought it for $250 and it's still worth $250? Yeah, there is no gain there, right? So yeah, you're covering the depreciation. But then if you put money into the property, you've stepped up your basis. I mean, call a CPA, right? But it may not be worth doing a 1031 depending on how much depreciation you're trying to avoid and whether or not you want to defer it.
I don't know. Is paying $1,000 to save $8 grand in taxes worthwhile doing?
Depends on what you're going to do with the money.
Agreed.
Yeah.
Even without the property going up in value, it might still be worth it. In this example, you got $30,000 in depreciation as 25% tax bracket. You're going to recapture $7,500 in that. Sure.
Yeah. And so, I mean, this is the common question. It always depends on what you're going to do, right? What's your plan for the money? Are you trying to, you know, why are you selling it if it's a break even? Do you just want to get out of that neighborhood, right? Are you looking to invest somewhere else? And then maybe a 1031 is great. But it also may be that you attempt a 1031 because you're like, hey, if I can 1031 from here to a different market, but then the other market doesn't work out, and you're like, well, I don't mind paying taxes on this. But if it's a $300,000 gain, and you're like got 75K of taxes at risk, it's a much different situation, I think. Yeah, Beth.
That is exactly my question. So if you try to do a 1031, you put it in the intermediary, and then it falls through, like how much does it cost for you to have that intermediary hold it? Like,
Yeah, it's fairly cheap. And I have a slide on the cost, but it's about $500 per closing. So if you sell one, it's $500. If you're really silly like me and you only give them less than 3 business days of heads up, then it's $700. It's a $200 extra rush fee, which they wouldn't waive for me, which was crazy. But then you go and buy 3 properties, it's $500 to each one of those closings for a delayed exchange. A reverse exchange is much more expensive, like $2 grand to $4 grand, because essentially they're taking title to a property that you bought, and in some sense, I'm sure this has happened, right? I bought this property and I couldn't sell the property I was going to relinquish, and now I'm hosed because you have this property and I can't buy it. So I'm not sure quite how that works, but it would be interesting. It's fine to bring money to the table. We covered that. So here's where boot comes in, and then we can have the full discussion. So same property, you bought it, you choose to sell it for $325, and there's 2 different kinds of boot, right? Still the same proceeds. So with a normal 1031 exchange, like, hey, we're going to buy a property for $400K, but we only put $75K down, right? What happens?
You get taxed on the remainder?
Yes, that $50K that we didn't put down is essentially money that we had capital gains on from the previous property. Yeah.
If that 50K was something you had saved over time, then you'd already been taxed on it from, say, your salary
This is coming from the sale of a previous property, right? This is coming from the sale of this property.
You're 50K down.
Yep, your 50K down is the first 50K of this 75, right? Make sense? Right? The government's never going to be like, hey, why don't you transfer your gains and we'll give you your down payment back. They're not going to do that, right? They may not be perfect, but they're definitely not on the dumb side of that one, because otherwise you could cheat the system. You could pull your down payment out, which is essentially a cash out refi, tax-free, which you can do in the other ways we talked about, right? Do the 1031, pull money out, or do it beforehand and wait long enough. But yeah, this 75K is essentially the 50K you put down and 25K of profit, which means you've got 50K of profit left over. And what are we going to do? This is cash boot, right? You're getting 50K in cash at closing, right? You still transferred, which is awesome, still did 1031 exchange, but the boot, which is that 50K, it's called the boot. I'm not sure why. If this was still at the Boot Grill, it would be an awesome class right now. It'd also be on one piece of paper that I printed out, and we wouldn't have this nice projector or the TVs, and it wouldn't be this long. We'd be done by now.
It'd be really loud, and we'd all be hungry.
Yes. So another example of boot. Does that boot make sense? So you take cash from those proceeds, you're paying tax on it, right? It's just like you sold that percentage of the property. Easy to understand. This is the more complicated example. You buy a property, you sold this one, 325. You buy a property for 300K and put 125K down. Things look good, right? You took all your proceeds and you jammed them into a new property. What's the problem? Yes, this is the problem. It's not just cash boot you have to worry about. It's also mortgage boot. The problem is the difference in the mortgages is now taxable, right? You can't just like turn your giant, $2 million apartment complex into a paid off 2 single-family homes, right? You've essentially downsized. The government wants you to either trade even or trade up. So again, the advice is trade even, right? If this was a $325,000 house, we're good. But in this case, you essentially are getting taxed on 25K because that mortgage value is 25K less. Make sense? That's the more complicated example. Call your CPA.
So can you put that in to my previous question, like you sell one property to pay off another.
You're just taking all cash proceeds, right, to pay it off. You already own the other property.
You have a mortgage on both, let's say.
But you own them both.
And you own them both.
I'm asking. You don't have to say you own them both. I'm just asking if that's your example. You're saying I have 2 properties, got a mortgage on each. I sell this one, and I want to use the proceeds to pay this off.
Right.
Yeah, you're not doing a 1031, I don't think.
All you're doing is taking the proceeds.
Yeah, I mean, you're essentially taking all cash boot. There's no 1031 because you're not having a replacement property that you're purchasing.
It's not an exchange.
Doesn't work for,
If you were going to, in some really weird way, if you were going to do a, whatever it was, the improvement exchange, and you were going to go put a ton of money into that to raise the basis of your other property, the problem is you still already own it, right? So it's not an exchange. They would just tell you, you're just paying off your mortgage. You'd end up paying taxes on the proceeds to then pay off your mortgage. So if you were trying to get to free and clear, I don't know that you can get there from this, right? You could sell that one property, buy another property that's worth more in value, let the value of that go up, cash out refi and pay off your other mortgage. That would work. But you're not going to get proceeds from a 1031 to pay off a mortgage that you already own on a property.
I'm thinking like separate LLCs.
You're still the taxpayer, right? Well, it's now you're inside the realm of you are not a what's the term I'm looking for? Arm's length transaction, right? You are a related party. So the government's going to see that in a heartbeat. Because on your tax return, you actually have to notate on any partnership, even if it's not the partnership return for that LLC, that you own X% of other partnerships over some percentage. So they're going to know. And if it's just single member LLCs, it all rolls up to your tax return anyway. So yeah, I don't think you can cheat the system on that one, nor would I advise it. Here, who asked the market? You asked the market question. James.
I asked the market question.
Oh, Dan asked the market question too. So things to consider in our market. Our market's crazy. We're the #1 stable market, which is great news, but our market's super tight. If I go and list a property with James, right, I'm gonna have 6 offers literally on the first day, hopefully, if I priced it reasonably, right? But it's gonna sell really fast. So what do we do about that? Assuming it takes 45 days for my property that I listed with James to sell and close, I've got a 90-day window to identify my properties. How many of you have been looking for longer than 90 days in this market and not found what you wanted? Yeah, like everybody's hand should be in the air, right? So that's tough. And imagine you're selling something that's, hey, I'm gonna have $1 million in proceeds and I'd like to exchange it into something larger. How many of those properties are coming on the market? Like 1 every quarter, right? You just don't see them. So you have to start ahead. This is gonna go by really, 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 really fast. And if you don't buy 1 or more of the properties you identified, your exchange becomes invalid, right? And that's the problem. So you've got 45 days post-close to identify your properties. You can wait till the last minute, but then if you don't buy one of them, exchange is invalid. Nothing you can do. Finding a property, right? This is the recommendation. Find your property ahead of time, get it under contract that you're gonna replace your property with, and get through all your contingencies, right? On the 45th day, if you're like, James calls and says, you just got it under contract and you still got inspection and loan objection and appraisal, that's gonna suck. What happens when appraisal comes in too low and you can't buy that property? You're now in a really hard spot. So if you can get through all of your contingencies on your contract and basically be lined up to close on your replacement, that, in my opinion, is the best thing that you can do for yourself in 1031s. And
before you identify it.
Huh?
You're saying that's when you identify it.
I'm saying identify well in advance, right? If you can, the property you're about to buy, your replacement property, right? If you can get through all of your contingencies on that contract prior to your 45-day deadline running out, you're in a good position, right? I think it's the best position to be in. Right? And like I said, if you're trying to do single-family home to 2 single-family homes, maybe that's feasible. But if you're trying to do 8-plex to 24-plex, how many 24-plexes came on the market this year? Or 20-plus units? Like 2? 3? Maybe? Right? It becomes really hard to find a $2.5 million apartment building to buy just because you want to sell your property. But there's a ton of people that want to buy your $1 million apartment building. So you get in a position where, hey, I've got 7 buyers that want to buy this, but I can't find anything to replace it with, which is a common complaint of sellers, and it ends up making them not sell their property. Kim?
Is there a problem going between states? Can I sell my Boulder property here and go buy a 16-plex in Memphis?
Not at all. Just get it under contract ahead of time. Yeah.
So I'll add an additional thought on this. I look at it a little bit differently. So the strongest negotiating position you're in when you're the seller is when you have the 6 offers in hand and you have not yet accepted one. And so one of the things I might talk to my seller about in that situation is negotiating before we accept their offer, which one could be flexible if we don't find our 1031 replacement in time, and say you are agreeing in advance that if we need to extend up to X number of days, that is actually included in your contract.
Yep.
And I think that could be a more interesting way to get your extension when you're having a hard time finding your buy replacement.
Yes. And so just to have the remaining part of that discussion now, the flip side of that is when a seller knows you're under a time deadline, they're very unwilling to do anything to help you, right? I'm trying to buy this property and they know you've got 2 days left to identify a property and get it under contract. Are they willing to bring their price down? Probably not, especially if they know that. So disclosing this information to potential sellers could be a detriment to your negotiation position. So be aware of what you're telling people, right? Even closing in 180 days on some deals, right? Single family homes, I mean, let's hope you can close in 180 days. But there are deals where, you know, there's someone in this room who, you know, may have something under contract that may or may not close in 180 days at no fault of their own, right? And that's crazy. I mean, it could be a year for all we know. So
I would talk more about that motivation side of things. I think that's
sure.
kind of important. So you're right that if you go to a seller and you're telling them you have a 1031 and you're in your 45-day selection period, you definitely give up negotiating power. And I know you mentioned before you were going to talk about things that get included in the contract.
It's coming.
I'm interested to see how you're handling that, because my understanding is that from a contractual standpoint, maybe not for the 1031, but in order to be able to assign it to the 1031 intermediary, you need to have something in the contract that gives you that right. Otherwise, a seller can say, no, I'm under contract with you, not with this other intermediary.
Yeah. You realize that you were an agent on a transaction where this happened with nothing in the contract when I was buying a property.
Oh, totally.
And it happened afterwards, and we were like, what is going on?
See, that's the thing, is that when somebody wants to buy and they're motivated to do that, it's one thing. When you're a seller
Yeah.
and you're like, no, I actually had an offer for $100,000 more, and there's an incentive not to close,
Yep.
everything changes.
Yes. Yeah.
So that's what's interesting about it.
Yeah. So I think the key lesson here is think about your position, and the more you can do to strengthen your position on both sides, which on the sell side is if you already know what you're buying and you're under contract and you're well down the path before your 45 days hits, you're probably in a much better position than, man, my closing is coming up on Tuesday and I still don't know what I'm buying, right? Because then panic sets in. Right? Oh my gosh, I have $50,000 of capital gains I'm going to pay if I don't find a property. So do you just suck it up and buy a property? Or do you pay taxes? Right? And when you start doing the math on that, in some cases it might make sense to just buy a property, wait a year or two, and 1031 into a property that you really want to own, even if you lose a few $1,000s on the property. So it's less than the taxes. It's crazy. So be aware of that stuff. Here's your big warning for the night, other than the fact that I'm not a CPA or an attorney. Choose your facilitator or qualified intermediary wisely. Why? What? They may have title, but they also, most of the time, they just have your money, right? You sold this $500,000 property and there's $200,000 of proceeds. Guess who's hanging on to that? Where are they putting it? What are they doing with it? How much regulation is there? Not much, which is kind of scary, right? They're likely holding large, you can tell it's small text. It's a big warning. They're likely holding large amounts of your cash. And what happened during the downturn? Lots of them went bankrupt. Now, if I stop and think about how a qualified intermediary would go bankrupt, I kind of think Ponzi scheme. But like, that's crazy. Oh, you had $200K of my money, and now I am under contract to buy this property, and you don't have my money? Craziness. Ask what their plan is. What happens if you guys file for bankruptcy? How am I protected? Hopefully they have a good answer for you. Don't just use some Joe off the internet for this, right? Save that for getting married or something. I don't know. Do they keep their funds in a segregated bank account? If they do, even if they go bankrupt, you should not have that much of an issue, right? Your funds are separated. Anyone that wants to hear a really long poker story about segregated bank accounts from large poker sites, let me know after class. I'll be happy to explain why that's super important, but they're allowed to do with what they want with your funds, right? This is insane. They can do what they want with your funds. Yeah, we're going to go invest in Microsoft stock. Wait, what? Now you understand how they went bankrupt and didn't have the funds. So go find a company that's bonded with a fidelity bond. They should probably have a per occurrence insurance policy. I thought I had policy twice. And this is what's even crazier. By law and by court cases, no extensions of the 1031 exchange. Like you would think, hey, my 1031 facilitator just went bankrupt. Can I get a few extra weeks to like figure this stuff out? Sorry, you just don't have a qualified 1031 exchange anymore. Now you're paying taxes on money you may not get, right? This shit just gets crazier, right? Here's some other things you might want to ask. Does the intermediary have tax professionals or certified exchange specialists capable of consulting with you, right? It's one thing to be able to like have some guy in a back room pump out the assignment and the exchange contract. It's another thing to have somebody be able to advise you. Is the intermediary a member of the Federation of Exchange Accommodations, which is a professional organization that basically holds members to the highest accountability standards, right? Much like being a realtor versus just being a real estate agent. We won't tell you that that's just a fee that you pay, right? They sign an oath. It's like, something like that. Does the intermediary have experience, right? Check out their reputation. Are they willing to meet with you? Are they willing to meet with you, consult, and help you with your exchange documents? If not, probably not getting very good customer service. Find somebody else. And are your funds available for disbursement within 24 hours? If not, what's going on?
So let me go back to that.
Yep.
So there was an episode of American Greed, we watched in late night TV once, of a 1031 exchange company that was basically going out and spending the 1031 money, and they would use the 1031 money that you guys put on deposit to go buy more 1031 exchange companies, so they had more money to spend, and they eventually acquired a very large number and basically went bankrupt.
Yep.
And this was a wild.
It's just a big Ponzi scheme, right?
It's really crazy.
It's just use incoming money to fund outgoing transactions, and if you can continue to acquire money at a rate that is equal to or faster than your outgoing spend, which across a certain period of time is likely, at some point it breaks down, right? You get too big and you just can't do it anymore, and then it's gone. Yeah, Kim.
So you said there's very little regulation when is that just in Colorado or is this across the board?
I think it's across the board.
I think so too.
States, I mean, there's
Yeah.
states where there's any kind of regulation.
There may be states that have more regulation than others, but I'm not aware of it.
Yeah, I think the key here, and it's why I didn't just use a random company, right? It's why I used First Bank, because I have a banking relationship with them, right? And I know how conservative they are with their banking and their lending. Like, I have to imagine that it's the same with 1031, right? And everything went super smooth. Does that mean they're untouchable? Probably not. But it's more likely that they're untouchable or they would back it if something went wrong than, some small title company who's also a qualified intermediary,
I
right?
have a slightly different take on the title company
Sure.
one. I think the large title companies, the
Yes.
significant, top 5
Yeah.
U.S. type title companies, I would say they're totally fine with 1031 exchanges and very large banks. I would agree. But
Yeah.
these mom and pop, small real estate brokers that decide to offer 1031 services,
Don't do it.
addition, I don't think that's worth the risk.
Yep. Yeah. But go ask these questions, right? Go find out information from them. All right. So this will be a lively discussion because there's 4 slides on 4 different additional provisions, and we'll see if James can pick his out or if it's not even there. These are the provisions that are put into additional provisions in the contract for a buyer and or a seller to do a 1031. And I'm going to read them and comment on them. So section 2.2, James, you know what section 2.2 is? I'm sure you do because it says no assignability right there. Right? Section 2.2 in the real estate contract basically says, unless otherwise specified in additional provisions, which is where this paragraph is, this contract is not assignable. Right? It was a recent change 2 years ago to the Colorado approved real estate contract where it used to have a checkbox. So now it just says it's not assignable. This basically says anything you put in additional provisions overrides the other section. So this is saying this is what we're replacing section 2.2 with. Notwithstanding section 2.2 or anything contained in this contract to the contrary, each party must cooperate to effectuate an Internal Revenue Code section 1031 tax deferred exchange undertaken by the other party that involves the property, including consenting to and acknowledging assignments of this contract to a qualified intermediary, so long as such cooperation is not to the detriment of the cooperating party. Make sense? We're all going to cooperate and sign whatever we need to sign as long as it's not to the detriment of the cooperating party. Is that yours, James?
I don't remember actually.
All right, you tell me when we hit yours.
Okay.
Here's another way to say it. Seller and or buyer, this is like, hey, if either of you want to do it, fantastic, right? The exchanger may at exchanger's option consummate, which is the funniest word to use here, the disposition of the property through a like-kind exchange pursuant to section 1031 of the IRC. If exchanger requests, The other party basically shall cooperate with the exchanger by executing additional documents as reasonably required to consummate the exchange, provided 3 things. 1, no delay in closing date. Because hey, if you're the seller and the buyer's like, well, I'm using 1031 funds, but I got delayed, you don't want to delay your closing. You may have something to do with your money. You may be doing a 1031. 2, exchanger shall reimburse the accommodating party for any additional attorney's fees not to exceed $250, which is like 7 minutes of an attorney's time, and costs incurred by the accommodating party as a result of the attempted exchange. So this is basically saying you might have to sign some documents as the non-exchanging party. I'm going to give you $250 so that you can take those to your attorney and review them and feel comfortable. Right? Makes sense. Number 3, the accommodating party need not assume any additional liabilities or obligations as a result of the exchange or attempted exchange, because your exchange may end up being an attempted exchange. Any questions on that one? James, is that yours?
I hope that's not mine, 'cause I don't like that one.
All right. They get longer, apparently. Man, it's like we're here. Maybe I just moved it up the screen. So, same thing. Buyer and or seller shall have the right at their option to acquire or dispose of the property through a transaction that is structured to qualify as a like-kind exchange under Section 1031, the Revenue Code of 1986. They were super specific. They just decided that IRC wasn't enough. We need to know it's in 1986. As may be amended from time to time, we're really covering our bases. Each party agrees to cooperate with the other party in effecting a qualifying like-kind exchange through a trust, escrow, or other means as determined by buyer and or seller. Each party shall bear the respective additional transaction costs, so we're no longer paying for attorney's fees, and all reasonable costs and expenses incurred by that party attributable to the closing of qualifying exchange requested by said party. In no event shall any like-kind exchange contemplated by this provision cause an extension of the closing date, we're still concerned about that, or the other party be required to take title to any other property. So basically almost the same as the previous one, but you can see some minor differences. James, is that yours?
No, there's one part of that I don't like either.
Oh, I thought I had 4.
Which one was mine?
That one.
That's the one I like best.
Yeah, actually, I think you should combine it with the parts of the other ones.
Yeah, there's a couple parts of the other ones I actually don't like. Like the part about the closing, I don't like that because there's room for misinterpretation of changing a closing date later and having them argue that it's that.
Yep.
So.
Yep, no doubt. So have your attorney, because your real estate agent can't actually draw this text up for you, or they're not supposed to, have your attorney draft something that fits your needs. Or ask the 1031 exchanger, hey, what's common? And see what they provide you with. But I've actually used all 3 of those successfully in contracts, which, as you guys know, if things go smoothly, it doesn't matter what's written down, right? Hey, we were supposed to close 3 days ago. You're still happy. I'm still happy. We're closing today. We didn't write an amend extend. Everything's great. We closed. However, he's not happy. Everything's going awry. So be cautious with that. Some notes on taxes. The qualified intermediary at the end of the exchange, which is super nice about at least my 1031 from First Bank, they sent me a packet that was like, here's everything you're going to need to give to your CPA. I was like, fantastic. I already had most of it put together, but you have some extra documents that I didn't even have. So they're going to provide that after it's complete. It's going to contain your assignment of your contract, your exchange agreement. It'll contain the deeds from closing, the settlement statements, and some other documents that they're going to provide you. So you just literally hand that to your CPA, and they will handle that for you on your tax return. You're going to file, or your CPA is going to file, Form 8824 to actually tell the IRS, hey, I did a 1031, here's the deeds. Here's some interesting stuff about taxes. Are there any CPAs in the room? No? Daniel, did you have a question? No. Oh, okay. You're just yawning or waving. That's fine. So, if you bought 2 replacement properties, hey, I sold property number 1 over here, and I bought property 2 and 3, one's worth $100K and one's worth $300K, right? And then I decide later in life, I'm going to sell one of those. How do we determine how much of the proceeds from the original one are actually now going to be taxed as capital gains, right? It's essentially exactly like you would think it is. It's just a proration based on the fair market value of these 2 properties at the purchase time.
Not the proration
Are you stating that as a fact or a question?
I am sort of stating it as a question because that's the other way to do it, right? If you have $300,000 and you put $40,000 into one property and $260,000 into the other, but they were exactly the same value, you could make a case that it's better for you doing it the other way.
Yes. Call a CPA. I don't have the answer to that. And it's funny because I actually took this from a transaction that I did where this happened, right? Where I put different amounts, not just equivalent amounts, right? So I pulled this from my CPA's answer, which when I think about it now is not 100% clear.
Which is crazy cool because you could actually structure this as a way to limit your taxes by always doing a small amount but larger.
You're still going to have to bring money to the table in that case, though, maybe, right?
Maybe, maybe not. Depends on how. I mean, you can work some math out. It could become pretty interesting.
Yeah. My guess is the prorate based on how much you put in from the proceeds.
That's what I would think. That's why when you said fair market value, it seemed weird to me.
Yeah, I wonder if it was written incorrectly in email to me or if I translated it incorrectly. So there we go. Note for next year, figure that out, Brian. Man, if that was confusing, I should just go to the next slide. This one's crazy. So there are two ways, right? Like you spend money on CapEx, which then gets added to your depreciation schedule as you own a property, right? Hey, I put a new roof on it. It costs 15 grand. It's depreciable across 15 years or whatever the schedule is for the roof. That's now on your depreciation schedule. So I buy this property. I put a new roof on it. It's got depreciation. I've paid for it. And now I'm 1031ing out. What happens not only to the depreciation on that property, but to the depreciation of the CapEx that I spent? Be prepared to be confused. You can either use the carryover basis from the old property and continue to depreciate over its normal life and add a new asset for any boot paid. Basically, the increase in basis is treated as if it were newly purchased property with a useful life, so 27 and a half years. Or the way which you're probably going to want to do it, which is currently the recommended way, you can treat the entire purchase as a new asset and depreciate it over 27 and a half years, which sounds pretty awesome, right? In many cases, the annual depreciation you're going to get on this new asset is equivalent to what you probably were getting or more on the previous asset, but the previous depreciation recapture is eliminated. That's the key point. Now, if you sell that property later, right, it's going to result in a higher capital gain, and it's going to depend on your tax bracket, right? Because you've essentially eliminated the depreciation, put it in a new asset, so now you've got more basis. Does that make sense? Just shake your head no, and we'll move on.
You've eliminated a 25% tax on depreciation and replaced it with a 20% capital gain tax.
Right. Or 15, right? But it's on a larger amount. So this is currently the favorable way for tax treatment, right? Yeah, it's percentages of a percentage of a number. And just in case anyone wants to go look it up, it's regulation section 1.168 section I-6. The IRS must be really long with their documents, don't you think? Don't you think? Yeah, I thought so. Everybody's going home to look that up right now. I didn't even look it up. I was like, I'm already well confused on this point. But that's what I did, right? So it was cool because the depreciation, and there were actual amounts in the email, and it made sense, but I wasn't going to put the amounts in because then I'd have to explain everything behind the transaction. But it was like, she put the amount, this depreciation amount is going to be basically eliminated. And I was like, well, that's fantastic. And then I just have a new asset that's being depreciated across 27 and a half years. Closing costs. A couple notes on closing costs. When you go to close on a normal rental property that's outside of 1031 exchange, kind of everything shows up on your settlement statement, right? Like Dan and Anna decide to sell me a property, and they're like, it's rented, it's currently getting $4 grand a month in rent, and it's halfway through the month, so they're going to owe me $2,000 in rent they've collected, right? They're like, no, we're not paying you that. But they're going to owe me that. They're also going to owe me damage deposits, right? Security deposits they've collected from their tenants. Those all get transferred. They're going to have to pay a fee for utilities, right? Their final water payment or whatever. So all of that kind of stuff is technically fine on a normal transaction to show up on a settlement statement, but not so much in a 1031. Why? Because it becomes taxable boot. Rent is not really a part of the transaction, if you think about it, right? Rent has zero to do with you selling this property and buying a replacement. It has everything to do with the operation of the property. So stuff that deals with the operation, that stuff doesn't show up on your settlement statement. You actually pay it outside of closing, which we'll talk about in a second. So rent, damage deposits, utilities, points, homeowners dues, HOA stuff, repairs don't happen on your settlement statement. The exchange company will be like, take it off, pay it outside of closing. So how do you do that? In this case, they would just write me a check at closing, or the title company in this case could also say, okay, from the proceeds that he was going to get, we're taking $2,000 in rent and $2,000 or $4,000 in security deposits, and they will issue me a check directly because it's actually me getting rent like I got it from the tenant. It's actually me getting damage deposit like I got it from the tenant. If you are the one selling the property, you need to write that check outside of closing. So I actually wrote a check from my LLC bank account that said, here's the $2,000 in rent, here's the $4,000 for this, and here's $700 for utilities, right? Very easy. Do get a receipt for this, because you're literally just writing what amounts to be a personal check or a business check and handing it to your buyer or seller at closing, right? So get a receipt from the title company. They'll watch the transaction happen, but get a receipt for that. When you sell that, if you get a refund, so here's the property I'm selling, it's the relinquished property. When I sell that property, we all know that lovely line item on there that's like $800 for water. You're like, my normal water bill is $60 a month and it's fully paid. They're like, yeah, we'll refund the rest later. So when that refund comes, how many of you are familiar with that at closing? It's silly, right? It's not $800, but it's like $350 or $400 for a water bill that's probably going to be $70. So when you get that refund needs to go to your qualified intermediary, right? That's part of your proceeds. It was profit on the house that we gave to the utility company that then they took what they needed and they handed us the rest of the profit back. If you take that yourself, it's boot. How much does the 1031 cost? Put this at the front next time. Typical cost, $500 per closing. If you sell one property and buy three, it's $2K, right? $500 on the sell, and then $500, $500, $500 on the buys. If you're slow like me, you can pay an extra $200 rush fee. Reverse exchanges are about $2K to $4K. That's really all I have on that. Oh boy, forgot this was in here. How many of you have been to asset protection? Yeah. How many of you guys are using trusts and LLCs, single member LLCs? So this slide is all for you. Pay attention closely because you may run into this issue and it was complicated and I've already thankfully done all the work to figure it out for you. So if you're using the common, I have a house and it's owned by a trust, which is owned by a single member LLC, which is owned by a master LLC, right, which owns that, and then you've got other stuff here, which I'm not going to draw the whole thing out. If that's the strategy you're using, what happens when you have a property that's titled in a trust and you want to sell that as your relinquished property? However, the property you're buying is now an 8-plex. You don't need the trust anymore. The LLC offers you plenty of protection and privacy, and the lender's willing to just lend to the LLC. So we don't need the trust. So technically, we're going from a trust to an LLC, which is still the same single member LLC. And if I haven't mentioned it, which I probably haven't yet, when you relinquish a property, the replacement property must be titled, basically owned by the same taxpayer. So you can't just like have proceeds from, James Orr LLC and then buy it in a new LLC. It's got to be in the same LLC or the same trust. So in this case, we have an issue because we might be going from a trust to where, in this case, this single member LLC, sorry, it's not this one. It would still be this one. We just want to own, a 4-plex, which has 1 building and 4 roofs. That's how you draw 4-plexes, in case anyone was curious. So Your seller and buyer must be the same individual or entity. But like I said, if now the lender says, hey, I don't need you to have a trust, and we're not a Fannie Mae 30-year fixed, lender, First Bank, or whatever is happy to just lend to the LLC, that's great. So that makes no sense to anyone, so that's why I did an example. Properties owned in 1234 Main Street Trust. Guess where the address of the property is? 5678 9th Street. No one caught that.
I got it.
Yeah. Right. So the property we own is 1234 Main Street. It's in 1234 Main Street Trust. Billy Bob is our trustee, right? Trusts have trustees. Single member LLCs have managers. That trust technically isn't owned. This should say the trust's beneficiary, right, is ABC Holdings LLC. Does that make sense? Okay, because if this doesn't, it's going to get really way more confusing. Billy Bob is also the manager, right? This is the strategy, right? You want to be the trustee of this trust so you can control it, and you want to be the manager of this, and you're probably a partner in this. The new property is going to be owned just by ABC Holdings, but the property we're selling was owned by 1234 Main Street Trust. So, here's what you need. In the assignment documents at closing, instead of using this and this, because they're not the same entity, we kind of mingle them all together to make it look good. 1234 Main Street Trust, on behalf of ABC Holdings LLC, its sole beneficiary, by Billy Bob as trustee. This tells the IRS this is actually the owner. This is what we care about. The other side of that, in the exchange agreement, right? So there's one for the relinquish and there's one for the replacement. It's the other way. It's ABC Holdings LLC as the sole beneficiary of 1234 Main Street Trust by Billy Bob as manager, right? This is the trust signing. This is the LLC signing. That's all you have to do, and so far I haven't been audited.
Why don't you pop it out of the trust and just do anything else?
What do you mean?
Why don't you pop it out of the trust before you actually sell it?
You could. Yeah, you could transfer title. Yeah, I think, I would ask a 1031 qualified intermediary about doing that
And
to
that's the right
avoid,
answer to all this stuff.
yes, to avoid, oh, you just transferred title, you haven't even owned the property for a year, because there are many cases, which I think is on my next slide, where there is some time that we care about. So if you ever need that, now you know where it is. And that was given to me by an attorney. So while it's not attorney legal advice to you, it was attorney legal advice to me. So I hope it's correct. Partnerships in man, I thought I was almost done. Partnerships in 1031 exchanges. If you remember at the beginning, like-kind exchanges are not done with partnership interests. So this is how you get around that in a couple different situations. So a partnership with two partners, so James and I, as an example, who wish to sell and go their separate ways. I'm not sure who's going to be, James, you want to be cash? Sure. You're just like, James says, I'm out of here, I'm going to Italy. I'm going to spend the rest of my life there. I just need the cash. And Brian says, I want to do a 1031 exchange. I don't want to pay cap gains on this stuff. We've held this property for 30 years. Like fully depreciated. This is going to suck, right? I'm going to pay, 20 to 15 to 25% average on this. How do we do this? Number one, carefully plan it before you do it. Prior to the sale of the partnership, prior to the sale of the property, the partnership needs to deed the property to the two of us. And it's done as tenants in common, which are called TIC, which stands for tenants in common. Does everyone understand what tenants in common are? Basically, you have an undivided interest in the property. So it's not like if James and I owned this room, it's not like James would own this half and I would own this half. There is actually no way to divide the property to show this is your half, James. It is an undividable interest. Each partner can then do what they want, because now Brian Williams is a tenant in common with James Orr, and we each have 50% ownership. So I could take my 50% ownership when the property sells, and I could 1031 that into something else, which is pretty powerful, especially if your partners are like, hey, we bought this 10 years ago. That was great. It's a great run. We're done. hey, no, I don't want to pay taxes. I want a 1031. They're like, yeah, we're retiring. We're out of here. You can handle that.
Are you talking about going the other way too?
I think so.
That works for like 70-30, I mean any percent.
Yep. Yep. And so this is known in the industry as a drop and swap, right? The drop is we're dropping it from the partnership to tenants in common, and then the swap is the exchange. So a lot of the times these are done at the same closing table, right?
So how do you value the property then? Like, are you, when you do your 1031 exchange, are you having to then?
It's whatever your percent ownership in the LLC was.
Just your percent?
Yes.
The $300,000 home, you only have to take that 150.
Yep. Yeah. And when you are a TIC, it usually says the percentage ownership on the title. So it's not like you can say, hey, James, do you and I want to be 50% owners, tenants in common? And then later we're like, you're not doing enough work. I'm going to take 60%. It's on title. It literally says James Orr 50%, Brian Williams 50%, tenants in common.
Probably have to deed additional percentage if you want to change that.
Yes. So it's recommended that you do the drop portion, right, from the partnership to tenants in common, 6 to 12 months before you actually do the exchange.
Hence the careful planning.
Yes, hence the careful planning. Here's another way. A partnership with 3 or more. So now we've got Dan and James and me who wish to sell, and some of the partners want to remain in the partnership, right? A little critical thinking gets you very quickly to, well, if Dan and I want to remain in the partnership and James doesn't, we drop his portion to tenants in common with the LLC, right? James, you get a third, and the LLC, Brian and Dan, get 66 or 2/3, because I'm not going to say 0.66666, right? He does that, and we basically split off, which is what it's called in the industry. We're splitting off. James is like, I'm out of here. But then the partnership takes our proceeds, and we're able to 1031 that as a partnership still. We've just split off from James. So very much the same. That was it. Any questions on that one?
So there's one that you didn't cover.
I got one coming. That's only 2.
I just wasn't sure if you missed
I said I was covering it. See, the title didn't change. We're in luck. So if this is the other way that James wants me to cover. You or your entity decide, hey, I'm going to sell my 4-plex here. And then Dan and James come to me and say, hey, we just found this 100-unit apartment complex. And I'm like, that's awesome, because I'm selling this. I'm going to have $200K. I'm ready to go. And I need to 1031 it. And they're like, well, we're just buying it. You can't do that. Well, you can, right? It's just the reverse of kind of what we just did, which is, apparently I used fun names. Billy Bob wants to partner with Sally Sue and Jazzy Jeff. I don't know where the Fresh Prince of Bel-Air actually is still. But Billy Bob, I guess I just showed my age or something. Billy Bob would take title in the replacement property as tenants in common with the others. So it's just the reverse. Instead of buying it in a partnership, we buy it as tenants in common. And so if Dan and James wanted to be in a partnership and buy it, that's great. Dan James LLC has 2/3 tenants in common. Brian Williams has 1/3 tenants in common. But I'm able to 1031 my proceeds in to essentially partner with other people. That's pretty cool. Some lenders will only allow you to do it with up to 5 tenants in common, so be aware of that. And I already said that. This is the other important point. So in a normal partnership, what do we have that determines how we operate? Operating agreement. In this case, we're tenants in common. It's not a partnership. How do we know how we're going to work together? We need to actually write basically an agreement that says this is how we intend to work. Similar to an operating agreement. And basically anything you're going to put in the operating agreement should probably put in this agreement, right?
Would you go up and create the LLC with the same percentages and reverse the process?
Yeah, I'm not sure if you can do a swap and undrop. I don't know how the IRS would look at that. I didn't ask, but that is an interesting question, right? Like you 1031 in, but I think the transfer from you 1031ing in to a different entity may trigger some tax. You may get taxed there. So yeah, call it 1031, specialist. And like I said at the beginning, straight partnership interests don't qualify. So you can't just 1031, hey, oh, you have a partnership interest in that? I'm going to just 1031 into the partnership. Doesn't work that way. And this slide actually, all the other ones were kind of jokingly for James. This one actually is for James, because this is the one slide he wanted tonight. How to pay no taxes on real estate. How do we do that? What'd you say? Winner. I don't think you want to win this game, right? But we're all going to win it at some point. Buy an investment property. Use 1031 exchanges throughout your life to exchange if you're going to sell. Always trade even or up in value, right? These are the basic rules for being successful. If you need cash, use a cash out refi to get it. When you die, your heirs are going to inherit your properties, right? Assuming that's what you do with them. We're going to assume that that's, James is not going to give them to me. He's going to give them to his kids. Unfortunate. I mean, I've taught all these classes. So this is the amazing part about dying for your heirs, right? Once they grieve and get through it, right? The basis of the properties gets stepped up to the current market value of what those properties are worth. So if you'd held on to properties for 30 years, fully depreciated, and basically if you sell it, you'd pay taxes on everything above what you bought it for, right? Now, it's like it was $300K when I bought it. It's now worth $2 million. My kid's basis is $2 million. That's awesome. Call a good estate planning attorney. The heirs may still have to pay income or estate tax depending on your estate plan, what the value of your estate is, and what tax law looks like when you actually decide to die. Because I can only tell you what it looks like today. So be aware of this. They may not be tax-free, but the properties themselves made it through your life without you paying tax on them, and now your heirs have them at a stepped-up basis. And unless they decide to sell them, right, there's not going to be any gain. And if they decide to sell them, hopefully you've taught them well enough that they use a 1031. I think that is, it's not it. Darn, all these cases. Last slide, I think. Can I own or occupy after a 1031 exchange, right? So this is a common question. Hey, I had this property. I sold it. I 1031'd into this other rental property. It's a single-family home. It's a beautiful home. You know what? I'm kicking my tenants out 2 years later, and I'm moving in. Sweet. Can I do that? Here's some kind of rules. The scenario I just gave you. Sell a rental property, buy a new one, rent it for 2 years, then move back in for 3 years. Can you then sell that house without paying taxes? Because technically you've lived there for 2 out of 5 years, right? And as long as you're under the either single or joint exemption for house, 250K or 500K, right? In theory, you should be like, well, I live there. Should not have to pay depreciation recapture or any capital gains. Wouldn't that be nice? It doesn't quite work that way. Basically, you're going to get prorated based on tax law at the time when you do this, depending on how much of the last 5 years was actually owner-occupied. And it's not just like, oh, it was 3 out of 5 years, therefore it's 60%. It doesn't work like that. So call your CPA, but you can do this to avoid some of the taxes. So if you wanted to be on a constant rotation of living in your rental properties that you 1031 into every 2 years, you could save yourself some tax. Or you could just die. It's much easier.
And so if you lived there for 5 years, you could...
I don't know that it ever gets to 100%. I think if I read it right, and this is an interpretation that's not probably valid, it looks like 1/8 of it is always going to be taxed. But it's not clear.
And the minimum is 2 years that you have to rent. Where's the loophole? I'm looking for the loophole.
Yeah, so the one question that was told, or the one thing that was told to me, because I said, hey, if I'm 1031ing into this property, but I actually just want to then sell it and 1031 into something else, how long do I need to wait? And the answer from the 1031 Corp was a year and a day would be safe. They're like, probably no problem in 6 months. A year and a day would be safe. 2 years would be better. So I think if you own or occupy a month after you 1031, it's probably going to be invalidated. I would say at least 2 years of time of renting it before you should move in. But
I will also tell you, clients have gotten different answers when they've asked this question to different intermediaries,
No doubt.
different CPAs. So I have different
Yeah, and that answer is actually derived from two answers. It's from an intermediary and from a attorney, I think. So.
But in actual, in real case situations, what have you heard of? Like, how
I have
soon
not heard-
has somebody been
Yeah.
caught? Or
I have not heard of anyone being caught.
The problem is you're going to put it on your return because you're going to have days of service of the rental property, and it's going to be a record of that, right? And so when the IRS comes and says you did a 1031 and then this property was in service for 74 days, fail, right? You're probably getting audited. No, is it for yours? Yeah. So I don't know many people that are just 1031ing and then owner occupying either, right? Most people that I know that are using 1031s are using it to literally trade up and trade up and trade up until the point at which they're happy or die. So, or die happy. There you go. Perfect. Yeah. Yeah. Anybody have any questions on 1031s? Did I leave anything out? It's the first time we've ever taught this class. Anything Mitch?
There's like a few appraisals in here. When are these happening? I mean, I guess there's these different bases there.
The appraisals happen when you sell
Yeah.
for the buying party and when you buy for whenever your appraisal is scheduled.
But as far as, you 1031 and I don't know, you hold it for 30 years,
Sure.
is there an appraisal kind of retroactive?
Like for the stepped up value if you die? Or for something else?
Trying to think through what I'm getting at. It was based on the fair market value. I guess they've just done it at closing, you said.
Yeah.
Okay.
Yeah, when you relinquish your property, it's, hey, I sold it for this much. That's what it's worth. It's fair market value, right? It's sold on the market. And then when you buy your new properties, right, the appraisal is done for those, but the appraisal isn't really what matters. It's what you buy it for, right? That's the fair market value. So you may pay over what it appraised for, and that may still be fine. May not be fine for your lender, but for your actual fair market value, that should be okay.
This opens up a really interesting discussion about owner financing with below market interest rates,
Yeah.
which is not going to happen tonight.
Yeah, I mean, there's all sorts of ways where you could try and skirt the system, but the system is already favorable enough that you don't need to, right? Just do the 1031s like they're designed to be done and save a bunch of taxes, right?
This is like people trying to fix my Nomad model. They're like, oh, but if you do it this way, it's better. I'm like, no, that's loan fraud. Don't try
Yeah.
to fix Nomad. Nomad's amazing as is. You don't need to mess with it.
Yeah, and I mean, it's no fun to be audited by the IRS anyway. So, don't set yourself up for that. Yeah.
So you've done several of these. So what were your motivations to do your 1031?
Sure, that's a great question. So motivation in one case was, I got a postcard that said someone had a bunch of 1031 money and they were looking to buy stuff and they were short on their deadlines. And I was like, oh, maybe I can get top dollar for my fourplex. And that's what happened, right? And I was like, I held it for a couple years and they paid me a bunch more. And there was a point at which I was like, maybe I shouldn't be selling this, but I sold it and that was why. And so I used that money to 1031 into something else. The other one was I had done a bunch of improvements and had a ton of equity. And so I was just, I think it's based on why you would sell any property regardless of 1031 exchange, right? I've got equity. My return on my equity is no longer good enough for me. My return on my investment is still great, but my return on equity is so low now that I would rather take this money equity-wise and buy something bigger so that I get a better return on investment and a better return on equity.
Okay, that's a good explanation. That's interesting.
Yeah. I would just think about it. Why would you sell any property? Because for the most part, I don't plan to sell properties that I own, right? They're lease option wise, yes. I mean, if they buy it, great. But even for those, the one lease option that I had where they didn't buy, I kept it as a long-term rental, right? I was like, why would I sell this, right? I mean, this is a great property now, especially with the market conditions. So, my personal take is, and I'm sure lots of other people have said this in the real estate world is, everything you sold, you're going to look back on and go, why did I ever sell that, right?
Yeah.
So it's hard, Sell stuff, if you...
Selling it like what you said, to buy something bigger, right?
But even
Yeah, even then, it's like I look back and I go, oh my gosh, right? That was great cash flow. It probably going to be worth more. Like, could I have found another way to buy something bigger without selling it? It becomes the common discussion of when is enough too, right? Like, at what point do you just stop and say, okay, let's start paying off mortgages, which is an entirely longer class that has no answer, which we won't teach.
Well, it's part of the return on equity versus return on investment class, where we go 2 hours just on that topic.
Yeah. Yeah.
So I really want to thank you because
Sure.
most of the classes I could teach, the topics that had deal analysis, stuff like that. This is one that I would have never gotten around to teaching. So I really appreciate you taking the time to teach it.
You're welcome.
And there's no gift card, but I will buy you dinner tonight.
Sweet.
So thank you.
Thanks.
On your behalf. You can get whatever you want.
There's this common joke of James being silly when he orders. If you've never been around, when he orders a hamburger, it's like, I'd like the bun from this one and the meat from this one. And I want this burger, but not with that cheese. Just the burger from this one over here, but not chicken. No mayo and no tomatoes.
Not true.
Yeah, it's very true. but then he will also walk into random places like Subway or Qdoba with me or his wife, and he'll be buying dinner, and he'll be like, he'll tell the people working there, she can have whatever she wants, anything. Just get her whatever she wants. And he'll repeat it like 42 times.
It's on me.
Yeah, it's on me. She can get anything she wants, which really confuses people. The Subway employee's like, is this a first date that's gone wrong?
They say,
Yeah. Do you need us to call 911? Yeah. So thanks for coming. Stick around for the class after the class. Hopefully this one recorded.
let's hope.
And we'll see you all next week.
Yes.